right now, regional banks are supposed to be fighting this brutal, bloody war for your deposits.
Oh, absolutely.
Like, every time you turn on the news or open a financial app, you see banks practically begging for capital,
Right.
paying out 4, 5, sometimes even 6% in high-yield savings.
Just to keep people from jumping ship.
Exactly.
I see.
Just to keep people from moving their money elsewhere.
Yeah.
So how did one independent bank just manage to pull in over $17 billion in deposits without paying a single cent in interest?
I mean, it sounds like a typo in an earnings report, right?
Yeah.
But it's actually the cornerstone of a very specific, highly insulated business model.
Which is crazy to think about.
It is, because when you look under the hood, you realize they aren't even playing the same game as the retail banks fighting for those high-yield savings accounts.
Well, welcome to this deep dive. Today, we have a really clear mission.
We do.
We're taking a stack of source materials, specifically West Bancorp's Q1 2026 earnings presentation and their corresponding news release.
Right, the official filings.
And we are looking for the hidden mechanics of resilience. We're going to explore how a bank achieves massive growth, keeps its expenses fiercely lean, and manages risk in a complex economic environment.
An environment that is, frankly, crushing some of its competitors.
Exactly. It's a masterclass in modern bank management.
Because we want to get past the headline numbers. You know, it's easy to say a bank made money, but we are looking at the why and the how. Like, how do the actual mechanisms of their daily operations shield them from macroeconomic headwinds?
Because whether you are an investor looking for an edge, a business owner trying to figure out your own cash flow,
right,
or if you're just insanely curious about how money actually moves at the institutional level, there's a shortcut to understanding financial resilience hidden right here in these numbers.
It really is.
Okay, let's unpack this. We have to start with the sheer scale of the top-line triumphs in the first quarter of 2026.
The scale is pretty wild.
It is. Net income hit $358 million.
Wow.
Yeah. That is $2.57 in diluted earnings per share, which is up a massive 23% year over year.
And, you know, a 23% jump in net income in a mature industry like banking.
Right. It's not tech.
Exactly. It usually means a bank either took on a mountain of high-risk loans or they managed a rare synchronized expansion of both their assets and their liabilities.
Then the sources show it's definitely the latter.
Yeah.
Total loans reached a record $58.1 billion. That's up 7% year over year.
Impressive.
But at the same time, total deposits hit a record $68.9 billion, which is up 9% year over year.
That's the synchronized expansion right there.
Think of it like a highly popular restaurant that is somehow managing to both increase its daily customer count, right? And they're getting every single customer to order the most expensive items on the menu at the same time.
It's a rare double win.
It really is.
Yeah. What's fascinating here is how that dual growth reflects the underlying success and the strength of the customers they serve.
Okay, see more about that.
Well, East West Bank has very unique roots in the U.S. Asian American immigrant community.
Right.
And their operations literally serve as a financial bridge spanning the United States and Asia.
Which I imagine is much harder to execute than just opening a branch on a corner in the suburbs.
Oh, radically harder. Facilitating cross-border commerce involves understanding regulatory environments in two hemispheres.
Right, the compliance alone.
Exactly. Managing complex foreign exchange needs, handling international letters of credit.
Stuff a standard regional bank just can't do.
They simply do not have the infrastructure or the cultural trust to step in and steal those commercial clients.
Interesting.
So as those fast-growing demographic and corporate bases scale up their own businesses, East West's balance sheet naturally expands right alongside them.
And we see the ultimate result of that in the value created for the shareholders. CEO Dominic Ng highlighted a metric in the release.
The tangible book value.
Right. Their tangible book value per share jumped 15% year over year to $62.27.
Which is a huge jump.
So for anyone unfamiliar, tangible book value is essentially the hard, cold equity.
Yep.
If you liquidated the bank today, paid off every liability, and stripped out any fuzzy intangible assets like goodwill.
The literal cash value.
Exactly. This is the actual cash value remaining per share.
And growing that hard equity by 15% in a single year drives what we call return on average tangible common equity.
The acronym you'll often see in the reports is ROTCE.
Right. And for East West, that number hit 17% for the quarter.
17%.
Yeah. That metric simply tells you how efficiently the bank's management is using shareholders' hard equity to generate profit. Hitting 17% places them in an elite tier.
But I want to pump the brakes here for a second.
Okay.
Because growing the raw size of a bank is technically something anyone can do if they just aggressively pay up for deposits.
Sure, you can always buy growth.
Right. A bigger bank is only a stronger bank if the funding is cheap.
Absolutely.
Which leads us directly to the puzzle I mentioned at the very beginning of the show, how they are sourcing their money, the deposit engine.
Because the cost of funding is the existential question for every bank right now.
Let's look at the actual numbers they reported for their net interest margin.
The NEM.
Right. This is the spread between what they make on loans and what they pay out on deposits.
And their net interest income was $671 million, up 12%.
Yeah. Their margin actually expanded this quarter by 8 basis points, pushing up to 3.49%.
In this rate environment, that's wild.
But the detail that jumps off the page to me is that the average cost of their interest-bearing deposits dropped by 21 basis points to 2.84%.
Which is very low.
And even wilder, a massive 25% of their total deposits are non-interest-bearing demand deposits.
Right, the free money.
Those grew by nearly $800 million in just 3 months.
Meaning 25% of their funding costs them 0%.
I have to challenge this because it defies current economic reality.
Out for it.
If I have cash right now, I could open my phone and get 5% from a dozen different apps.
Yep.
Wait, aren't banks supposed to be fighting tooth and nail, paying high yields to keep deposits right now? How on earth is East West Bank getting a quarter of its deposits for literally 0% interest? Where's the catch?
There isn't a catch. It's just the difference between retail consumer psychology and commercial operational reality.
Okay, explain that.
When the media talks about the war for deposits, they're almost exclusively talking about everyday retail consumers chasing yields with their personal savings.
Right, me moving my savings account for an extra percent.
Exactly. But East West's model is overwhelmingly commercial. Over 70% of their loans support mid-sized and large businesses.
So these aren't folks looking to park their retirement nest egg.
Not at all. If we connect this to the bigger picture, these are chief financial officers trying to run multinational companies.
Oh, I see.
A corporation needs an operating account just to keep the lights on. Think about what it takes to run a mid-sized logistics company importing goods from Asia.
You'd need a lot of cash on hand.
Millions of dollars, highly liquid, readily available on any given Tuesday to make domestic payroll, receive international wire transfers, pay overseas vendors.
Oh, so you can't tie up Friday's payroll in a 6-month certificate of deposit just to chase a 5% yield.
Exactly. The money has to be instantly accessible. These are demand deposit accounts.
Right.
When a bank integrates its technology and services deeply into the daily financial plumbing of a successful corporation, that business is forced to leave a massive amount of cash in those zero-interest operating accounts simply to function.
It is incredibly sticky money.
Very sticky. And it directly drives their profitability because they are taking that cheap deposit base and funding a loan portfolio with an average yield of 6.11%.
6.11%.
Yeah, that spread is pure profit.
Okay, so they have a massive pool of cheap funding. But what exactly are they doing with all that cash?
They're lending it out.
Right, but anyone can get a 6% yield if they lend to risky borrowers. Let's look at their record-breaking loan portfolio and a very specific, highly successful niche they've carved out.
The $58.1 billion loan book.
Exactly. As we noted, commercial lending dominates. They have over $21.4 billion in commercial real estate and roughly $19.6 billion in commercial and industrial loans.
But buried inside that is a fascinating niche.
Yeah, here's where it gets really interesting. A major driver of their growth is their NDFI portfolio.
Which stands for non-depository financial institutions.
Right, and specifically, about 30% of those NDFI loans are dedicated to something called capital call lending.
This is a highly specialized, incredibly lucrative corner of institutional banking. Very few everyday investors ever see it.
When I was reading through the source material on this, the best way I could visualize capital call lending is to think of a VIP nightclub bouncer.
A bouncer? Okay, how so?
Well, it's incredibly exclusive, right? The borrowers are highly vetted private equity and investment funds. And the risk of someone not paying their tab is practically zero.
That's actually a great analogy.
The presentation states this flat out. The NDFI portfolio has had virtually zero net charge-offs in the past decade.
10 years.
10 years of lending billions of dollars, and 99.99% of the loans are current.
It's bulletproof.
How is a multi-billion-dollar loan portfolio operating with practically no losses?
Well, let's walk through the mechanics of capital call lines because it explains why they are so secure.
Okay, break it down.
Imagine a massive private equity firm decides they want to buy a software company. Now, that firm doesn't actually hold billions of dollars in a checking account.
Right, they have investors.
Exactly, commitments from their investors who are known as limited partners.
And these limited partners aren't just regular wealthy people, right?
No, we are talking about state pension funds, university endowments, sovereign wealth funds.
The deepest pockets on the planet.
Right. They sign a contract promising to give the private equity firm money when a good deal is found.
Okay.
But when the private equity firm finally signs the papers to buy that software company, they need the cash to close the deal today.
They can't wait.
Right. If they call up the state pension fund and ask for the money, waiting for those committees to approve the transfer and wire the cash can take weeks.
The deal would fall apart.
So East West Bank steps in. They provide a short-term line of credit, a capital call line, so the private equity firm can buy the company immediately.
But the collateral for the loan isn't the software company they're buying, right?
No, and that is the genius of it. The collateral is the legally binding contractual commitment of those limited partners.
Oh.
The bank is essentially lending against the creditworthiness of a sovereign wealth fund.
The VIP at the nightclub.
Exactly. The private equity firm calls the capital from their investors, the massive institutions send the cash a few weeks later, and the firm immediately pays back the bank. It provides East West with excellent, steady yield, completely without the volatility of traditional consumer lending.
So we've established they are making safe, profitable loans. But interest isn't their only revenue stream.
Not at all.
They are also making a killing on fees while keeping a tight leash on the corporate credit card.
Right, the non-interest income.
They brought in a record fee income of $99 million this quarter.
Up 13% just from the previous quarter.
The sources note this is driven by wealth management, deposit-related fees, and foreign exchange, which makes perfect sense given the cross-border trade we talked about.
Absolutely.
But here's the number that stopped me in my tracks. Their efficiency ratio sits at a best-in-class 36.2%.
That is a staggering figure in modern banking.
Let me push back on this, though. The math for an efficiency ratio is basically non-interest expense divided by revenue, right?
Correct.
So an efficiency ratio of 36.2% means they spend roughly 36 cents to generate $1 of revenue.
Yes.
But wait, if they are so efficient, why did employee compensation just jump by $21 million in a single quarter? Like, are they getting bloated? Are they suddenly having to pay up to retain talent?
You'd think a sudden $21 million jump might be a red flag, but you have to factor in the calendar cycle of the financial industry.
Okay.
The source material explicitly clarifies that this bump is strictly due to seasonal factors.
Like annual bonuses.
Exactly. First quarter bonuses, the payroll taxes associated with them, and the annual vesting of employee stock-based incentives.
Standard Q1 stuff.
Right. But this raises an important question about what efficiency really means here.
Okay, let's hear it.
An efficiency ratio of 36.2% is actually incredibly lean. A traditional, well-run regional bank typically operates in the mid-50s or even the low 60s.
So spending 55 cents to make a dollar is considered a success for most banks.
Yes, because traditional retail banks have massive expensive footprints. Hundreds of physical branches, huge marketing budgets, trying to lure in individual checking accounts.
Right.
East West operates a highly targeted commercial model. Handling multi-million-dollar transactions for mid-sized corporations requires far less physical real estate.
That makes total sense.
Yeah.
They don't need a branch on every corner to land a private equity client.
Exactly.
Okay, so they are highly efficient and highly profitable. But banking is ultimately about preparing for a rainy day.
Risk management.
Let's look at their safety nets and what management thinks is coming next.
Yeah.
The asset quality, the share buybacks, and the 2026 outlook.
Right, because in a high-rate environment, this is usually where the cracks start to show.
But their asset quality is remarkably stable. Non-performing assets are totally flat at just 0.26% of total assets.
Barely a blip.
And net charge-offs held at a very low $12 million.
Which is nothing for a bank that size.
Exactly. Yet, despite this stability, they provisioned $36 million for credit losses this quarter.
Yeah, they actively bolstered their allowance for loan and lease losses.
The ALL,
Mm-hmm.
they bumped it by 2 basis points to 1.44%, totaling $836 million.
A massive rainy day fund.
So what does this all mean? If their credit quality is so stable and charge-offs are so low, why are they hoarding an extra $36 million in the allowance for credit losses? Are they seeing a storm coming?
It's a very natural question, but the sources cite loan growth and a change in portfolio mix as the specific reason for the AL bump.
Meaning what exactly?
It's just prudent risk management. Their total loan book grew by over $1 billion.
Right.
As the loan book gets bigger, the safety net underneath it must grow proportionally, mathematically speaking. Even if the skies are currently clear and the new loans are pristine, you have to hold a proportional percentage of cash in reserve against them.
So they're just building a bigger safety net because they have a bigger trapeze act.
Exactly.
And you see that confidence in how they treat their shareholders. They repurchased $98 million in shares during the quarter.
At an average price under $105.
Right, and they declared a Q2 dividend of 80 cents.
They throw off enough free cash to fund loan growth, pad reserves, and still hand millions back to investors.
Which brings us to the full year 2026 outlook, expecting 5% to 7% loan growth.
And 6% to 8% NII growth.
But the detail here that is so crucial, they built this assuming the March 31st forward curve.
Right.
Meaning with absolutely no rate cuts.
Which separates them from so many of their peers who are desperately praying for the Fed to cut rates.
Yeah.
East West is saying, we don't need cuts to grow.
So bringing this all together for you listening, understanding East West Bancorp's Q1 performance isn't just about one bank stock.
No, it's bigger than that.
It is a blueprint for how a targeted strategies like bridging U.S. and Asian markets, combined with rigorous discipline, creates massive shareholder value in any economic climate.
Cheap deposits, zero loss capital call lines, 36.2% efficiency.
Exactly. Which leaves us with a final provocative thought to ponder. The bank's 2026 outlook projects continued growth while assuming absolutely no interest rate cuts this year.
Right, the higher for longer environment.
But if they can achieve a 17% return on tangible common equity in that tough environment, what hidden levers might a bank like this pull if the macroeconomic environment suddenly unexpectedly flips and rates actually drop?
Now that is the multi-billion-dollar question.
It really is. Thanks for joining us on this deep dive. We'll see you next time.